Welcome back to House Rich, the real estate show, home of the world's best home buying tips. Today we're going to talk about rising interest rates and what you can do about them. The short answer is absolutely nothing. Still our video podcast over, but you may look down there, see there's about 8 to 10 minutes left. So we're going to talk about some solutions, what you should be looking for in the first place. But let's get right into it. So first off, the interest rate honestly should not matter to you because you can't do anything about the interest rate. It is what it is. There's a certain point, no matter how good your credit is, there's a floor to the interest rate. So right now that they're recording this podcast, that floor is somewhere in the 4.5 to 5.5%, depending on what your loan size is. And there's nothing you can do about that. 5 months ago, the ceiling may have been 3.5%. So when I say the ceiling, I mean there's a certain point where your credit's so bad you can't get a loan. So like the max interest rate could have been like a 3.5%. So let's talk about what you should really be focusing on and not the interest rate instead of the interest rate when buying a home. The first thing is your budget. So with interest rates rising, your purchasing power is going to be less, meaning that you can buy a smaller home, but your budget is your budget. And so always start with your budget. So if your budget is, let's say your budget is $1,000 a month to make the numbers super easy. What you need to do is go to google.com and type in the word or the phrase mortgage calculator. And what'll pop up is a mortgage calculator. And so you want to mess around with the numbers until you can find out what purchase price gets you to $1,000 principal and interest payment. In actuality, a little bit less, maybe to like a $700 principal and interest payment. Once again, these are just numbers to make it that are super round numbers. You're probably going to be, not probably, you may be way higher. But so you mess around and let's say that you figure out that a $150,000 home in Google will get you a principal and interest payment of $700. Okay, so now what you want to do is you want to go to Zillow or Realtor.com or something like that, and then go find homes that are about $150,000 on there. And then so now what you want to do is look at the taxes on that property. So let's say the taxes on that property are $2,400 a year. So $2,400 divided by 12 months in the year, your monthly taxes are $200 a month. So now we take that 700 plus 200. Now we're at a $900 a month budget. And then so you got to figure out this for your specific region, but taxes, let's say they're $100. Talk to an insurance guy or gal for that to figure out what the taxes are in your area. But now let's say they're $100. So 700 plus 200 plus 100 equals $1,000. So now you know a $150,000 house will get you a $1,000 a month monthly payment. So that's what you really need to be focused on is your monthly payment. So that's the first thing, independent of the interest rate, is figuring out what your budget is. The next thing is really hey, do I have a steady job or form of income? If you don't, you probably shouldn't be looking for a home. I mean, if you think you're going to be relocating or moving, or you really shouldn't be looking for a home because you're not going to have the flexibility that you need. Everyone says, hey, you can buy a property and then just rent it out and do all that. Maybe not. Everyone says, hey, buy a home. Home price is going up so quick that you can sell it right away. Maybe not. I say that pretty sure the person that's telling you that is profiting off of you buying a home. So I would take that with a grain of salt, how quick that you can, you can flip that property because you got to pay realtor fees, realtor commissions, you got to pay fees when you sell the home and all that. And so let's say you buy a home for, what's going to make a number super easy. Let's say you buy a home for $100,000 and then, I don't know, 6 months later, the home is worth $120,000. That's $120,000. That's roughly a 20%. That's a 20% increase in prices, but you still got to pay like a 6% realtor commission and other fees. You got to move your home and all that. And so you won't profit the way you think you would have profited. You got to pay lenders costs to purchase the home. You wouldn't have profited the way that you think that you would have profited during the sale. So make sure that you have a steady job because you should anticipate to be in the home for at least at a minimum a year, but I would say like 2-3 years a minimum before you can realistically expect to turn a profit if you're just looking to turn around and sell the property. And contrary to popular belief that you see on the internet, you also need some sort of like savings. Now, folks that make it out today, you can buy a home, no money down, and blah blah blah. You need some sort of savings in case something happens. taxes go up, insurance goes up, stuff may break in your home, even a new home. You need to have savings as well in case something happens, especially if the plan is, hey, I want to eventually, live there for a year and then rent out the place. Well, what if you can't find a renter? What if the renter doesn't pay the rent? What if the renter breaks something or something like that? There's renter insurance, there's homeowner insurance, but you need to have money in case just something happens. So contrary to popular belief, you need to have money as well. And so those are some things you be looking at before you buy a home. And so here are a few ways that you can actually reduce your interest rate. So first thing is you can buy down the rate. And so what is buying down the rate? Buying down the rate is essentially that's paying like prepaid interest. That's what you call like points. And so there's some math you have to do with that. And so what you want to do is you want to weigh the cost of buying down the rate versus the reduction in the actual monthly payment. So let's say it costs you $600 to buy down the rate, but it's only going to reduce your monthly payment by $6. So the math you can do there is 600 divided by 6. It's going to take me 100 months to recoup the savings for buying down the rate. And so if you're going to be in the home for longer than 100 months, it makes sense to buy down the rate. If you're not, it doesn't. And so you want to do that specific math in your scenario to see, hey, does it make sense to buy down the rate in the first place? You'd also do like an adjustable rate mortgage. And so with an adjustable rate mortgage, your term is locked in for a certain number of years, and then it adjusts. And so typically you'll see an adjustable rate mortgage like a 5-1, a 7-1, a 10-1. What that means is it's locked for 5, 7, or 10 years. And then at the end of 10 years, the market goes where it goes. And so it's kind of like a roll of the dice. And so your interest rate in an adjustable rate mortgage is less than the market. So let's say rates right now are at 5%. Your ARM may be at a 4.625%, something like that. And so you're like, hey, I want to roll the dice with the lower rate now? But in 5 years with the market could be lower, great for you. It could be higher. So let's say you did an ARM. Let's say you did an ARM 5 years. Oh, I don't know. 5 years ago, they're probably the rates are similar to now. But let's say you did an ARM, which would have made no sense, but you did an ARM like 2 years ago when rates were like in the 2s and 3s. In 3 more years, if rates are still the same, your rate could jump from a 3.000 up to a 5.500, something like that. So there is risk with the ARM. Just kind of food for thought there. And then another thing you can do is basically lower your loan to value ratio. So interest rates are impacted by your LTV, loan to value ratio. And so typically your threshold marks are, you'll hear them when you talk about down payment for home, but it works the same for refinancing. So interest rates are impacted at these thresholds, 97 or 100%, but that's just for a purchase. 97%, not going to be a refi in that scenario. 96.5%, that's 3.5% down for an FHA. Then 95, 90, 85, 80, 75, and it goes down. Basically, you'll see kind of every like 5 or 10 percentage points, you'll typically get a better interest rate to an extent. And so, maybe if you're like, hey, my loan amount is going to be $201,000 or something like that, $2,100, $200,000 plus like an extra $1,000. So you may say, hey, you may want to pay an extra, $1,000 towards your closing costs in order to lower that loan amount to get you at that 80% LTV, if that's kind of the scenario for your home right there. And then last but not least, my favorite is, of course, hopefully you know what I'm going to say, you want to shop lenders. That's just a basic thing to get you the best rate. I always say, figure out what lender you want to work with, then shop rates to figure out who has the best rates, and then have the lender that you like get you the rate that you want. And so that's my advice when it comes to rising interest rates. There's nothing you can do about them. They may go up, they may go down. No one knows, the contrary to popular belief or whatever your favorite guru may tell you. They don't know where rates are going. So appreciate you all. If you listen this long, leave a review, share with a friend to the podcast. Like the video, share with a friend. That helps me get more. Actually, it helps me promote the podcast more, get the podcast out to more people, and honestly, it helps me get more more money too. So podcast is free, but you can leave me a rating. Do 5 stars or nothing. Don't give me no 4-star rating. So that's all I got for you guys. Until we meet again. See you next week. This is a wild one. I gotta start rehearsing these things.